Hello there, friends. In a recent survey, 60% of Americans said we're headed toward a recession in 2020. 75% of economists say we're headed for a recession in 2021. We're going to take a look at the three top indicators of a recession. So stay tuned. Hello again, friends. This is Richard with Wisdom Investor. We're going to take a look at indicators for a recession. There's a lot of talk about a recession. We talked about the surveys that are going on. We're probably going to talk ourselves into a recession before anything happens, but we're going to look at the indicators for a recession. We're also going to look at what's going on in the markets. We're going to look at what's going on with the Fed and if there's anything serious to be aware of in the market. So I want to thank you for joining us. Hit the subscribe button if you haven't subscribed yet. Also, leave a comment. I know we've got some sharp folks out there. You got some good ideas, and it's very helpful for everybody involved. And if you like any part of the video, hit the like button. So I thank you for watching here. So let's get started. We talked about 70% of economists think a U.S. recession will strike. This was in Business Insider. And then we also talked about 60% of Americans think a recession likely hit in 2020. So there's a lot of negative news out there. Be careful too what you're listening to out there. If you're watching nothing but negative news, you're going to miss some opportunities in the market. So you got to be real careful. But there's good reasons why people are thinking of a recession. So we're going to take a look at some of the top indicators here. And so one of the biggest indicators is employment and unemployment. And so currently the employment is very high right now. Unemployment, we're looking at the unemployment chart here. Unemployment now is down to about 3.3% as of August down here in the bottom. And so if this unemployment line starts to go up, that is going to be one of the indicators we're going to be watching here for a recession. Now, a lot of folks are going to say, well, I don't believe those numbers. They're a bunch of fake numbers and so on. Well, they're doing the best they can. Okay, they may not be perfect, but it's something to go by. But bottom line is, when these numbers do rise, a recession will be coming along. You can also watch your state numbers. If you see your state unemployment rising, you know it's starting to get to hit us here as far as a recession. So in general, we're going to watch these numbers on the big picture. We know they're not perfect, but we want to use every bit of information we possibly can to know where we stand in the markets here. Another indicator, we talked about this in our last video, and this is from Mother Jones here, and is the yield curve. And so when we have a short-term interest rates here in this graph higher than the longer-term interest rates, that's an inverted yield curve. This was back in August of 2014. You can see the 5-year, 7-year were below the 1 month and 2 month. So people are trying to keep their money short-term because there's less of an opportunity on the long term. Here's probably a normal curve, or what it was like back in January 2nd. You can see the long-term rates were much higher than the short-term rates. So this is a good indicator. Every recession has started by an inverted yield curve, but not every inverted yield curve is going to be a recession. So we'll have to watch this real close. Another area is growth. How is the growth in the markets and in the economy? Now we're looking at the transports here right now. FedEx just came out with earnings today, and it was down several percent. I don't know how it ended up at the end of the day, but this is the transports. This is 2019, and you can see we're starting to develop lower highs here. And if we can't break up in the transports companies like FedEx, UPS, and others, they carry the freight. Okay, and if we start to see less demand and see their stock prices drop, that's going to give us a good indicator of what's going on here in the markets. Now, I will say this, UPS is doing pretty good. So we've got a lot of mixed messages out there in the market right now. But FedEx did drop. It's probably a good reason why this was dropping. But we're going to keep our eyes on the transports. There's other trucking companies that have gone out of business. Overall, what I'm seeing out there in the economy, unemployment is good. We do have the concerns about the yield curve. The Fed just lowered the interest rates today. If the economy was that great, why in the world would they be lowering rates? Typically, if the economy is getting better, you're going to be raising rates. And so that's a concern for everybody. The stock market is high. It's up at the highs here. Real estate is up at the highs. But by keeping those rates low, it's going to do two things. One, it's going to keep housing growing. They just had some numbers today on new housing starts, and they were very positive. So they got to keep this housing going. They're going to keep the interest rates so people can get their loans. They got to inflate the market. That's what they're trying to do here. And the other reason is for our national debt. The interest we pay on the national debt is enormous. And if we raise those interest rates, that means we're going to be paying more money. And so we'll be paying more money to these countries that buy our debt and of course individuals. So they got to keep that rate down for national debt reasons and also keep that housing business going because it supports a lot of workers. Now, something going on here just recently I've been trying to keep my eyes and ears on is they've been talking about this, we'll go down here, there's an article out of Market Watch. And here it says the Fed injects more into money markets after banks bid heavily for funds. The Fed just pumped $128 billion into markets to pull down interest rates. So the overnight lending rate, this is a little bit complicated, but they kind of explain it pretty good in this article here. The overnight lending, they ran across some problems. There wasn't enough money in the market, so the Fed had to inject money. There wasn't like liquidity. Back in 2018, when the market was crashing down, there wasn't any liquidity. There wasn't any money there to support the markets. So we're going to watch that real close. But here's what they say. They say basically the repo market is like plumbing in the U.S. financial system, making sure banks have enough cash to meet their short-term needs. And they go on and say the borrowers the next day pay back these loans with interest. Essentially, they repo the bonds. But go on. But when there's fear in the market or when there's not enough cash or sufficient reserves in the system, the repo rate can explode like it did this week. So we're going to watch this to see if we have any repercussions from this because this is going to be the supporting factors here in our markets right now. So let's go over here and we're going to take a look at what's going on in the Dow Jones Industrials. This is a monthly chart. So basically, as far as my own investing right now, I'm in long-term S&P 500 in my long-term plan, and we're dollar cost averaging. So this is a monthly chart. Basically, despite all of the ups and downs here, we're still positive here. Okay, we're still looking pretty good. So long-term money, dollar cost average, that means put a little bit every month. You get a paycheck, a little bit goes into the market because it's going to be up and down. We're not into a major downturn right now where we want to protect our money. As far as lump sum investing, putting big dollars in right now, I personally wouldn't be doing it. It's because the market is, I think there's some warning signs out there. If you don't want to invest in the market, then be in a good money market. Take a safe route. So I do have money in a money market, and I'm looking for some opportunities. Now, I'm getting myself ready for retirement, and I want to build my cash reserves. I do some shorter term trading on a daily basis, not a day trading type thing, but I look for the swings in the market, and I want to pick up some extra profits on the short term swings. But for the big picture here, for the average person, dollar cost averaging, we're okay right now. This is Dow Jones Industrials. We're up at the highs here in mid-September. Just look at some of the indicators here, As the market has moved higher, we're showing less strength on the relative strength index here. So unless we get an injection of money, injection of force, of thrust, volume into the markets, we're starting to kind of slow down right now. The volume to the upside, even though we're higher, is really low on the weak side at this point. The QQQ NASDAQ 100, same things, holding up. Again, dollar cost averaging, but you can see we have a negative divergence as the price was higher here back in 2018. You can see our relative strength was much stronger. Now the market's higher, but we're showing less relative strength. Now this is on a monthly basis. A lot of things can happen on a monthly basis. Lots of movement here inside these candlesticks on a monthly basis. Let's take a look at the VIX index. We'll be watching this now. There's a possible setup here for the VIX to move higher. VIX index is measuring the number of puts in the market, people that are investing in puts and options, thinking the market's going to go down. They protect themselves with puts. So this level is higher than it was back here. And then our S&P 500, you can see, is pretty much at the same level. But we do have a difference here. The VIX likes to take off when it's developing a higher level, while the S&P 500 is a higher level. Now, if this VIX was all the way down here, that would be a real sign of strength in the markets. As the VIX goes down, that's strength in the markets. So those are some of the things we'll be looking at right now. So I do appreciate you watching. Leave your comments. I know we've got a lot of very intelligent people and you have another angle to things, or maybe you can add to the discussion. I appreciate it very much. So leave your comments. Hit the subscribe button if you haven't subscribed, and hit the like button. So I want to thank you for watching. Our video schedule here right now is going to be on a weekly basis or as things happen in the markets. And we're also going to continue with our retirement planning videos. You'll be seeing those. Those usually come out towards the end of the week. So thank you for watching. Have a great trading week.